The internet services industry, spanning digital transactions, logistics, e-commerce, and cloud solutions, is undergoing rapid transformation fueled by technological innovation and evolving consumer expectations. While the sector presents significant growth opportunities, it also faces critical challenges, including heightened data privacy concerns, increased regulatory scrutiny, cybersecurity threats, and rising customer acquisition costs. As competition intensifies, sustained success will require companies to differentiate through innovation, operational excellence, and superior user experiences. DoorDash has established itself as a leader in last-mile delivery by leveraging a hyper-local logistics model and advanced data analytics to optimize routing and delivery times. Its competitive edge stems from a dominant market share in food delivery, strong restaurant partnerships, and strategic diversification into adjacent categories such as grocery and retail delivery, which enhances customer engagement and platform loyalty. Shopify provides a robust, scalable e-commerce platform that empowers small and medium-sized businesses to create, manage, and grow their online presence without requiring deep technical expertise. Its all-in-one solution, extensive partner ecosystem, and app integrations, along with support for headless commerce, position it as a flexible, decentralized alternative to Amazon's platform. Uber continues to lead in the ride-hailing and food delivery markets through its expansive global reach, dynamic pricing algorithms, and integrated multi-model platform. Its data-driven logistics capabilities and strong brand recognition drive powerful network effects. Uber's investments in freight services and vehicle technologies reflect a forward-looking strategy focused on long-term diversification. Dropbox, a pioneer in cloud storage, differentiates itself through a user-focused design and productivity-enhancing tools, such as Dropbox Paper. Despite strong competition from tech giants like Google and Microsoft, Dropbox maintains relevance by offering reliable file synchronization, seamless collaboration features, and integrations that cater to small businesses and creative professionals. To remain competitive in this dynamic landscape, internet services first must prioritize investments in artificial intelligence, secure cloud infrastructure, and robust regulatory compliance frameworks. Long-term success will depend on balancing growth with reasonable data practices and fostering user trust through continuous customer-centric innovations.
Hello, my name is Matthew Frisby, and I will be covering the business environment and past performance sections of our presentation. The internet services industry is the cornerstone of our digital era. This industry provides the essential infrastructure and platforms enabling users and businesses to access, navigate, and operate on the internet. Key services include internet access, cloud computing, web hosting, streaming, e-commerce, and social media platforms. Economically, the impact is significant. The internet-supported economy accounts for 12% of the U.S.'s GDP and has generated over 17 million jobs, reflecting its vital role across modern industries. Major players shaping this landscape include tech giants like Google, Amazon, Meta, Microsoft, and leading telecom providers such as Comcast, AT&T, and Verizon. Understanding this economy is crucial, as it underpins the digital experiences we rely on daily, from browsing and streaming to conducting business and staying connected. The internet services industry faces several pressing challenges. Data protection and regulations. Stricter data protection laws like the EU's GDPR are compelling companies to enhance transparency and user consent mechanisms. Non-compliance can lead to significant fines. Cybersecurity threats. The industry is under constant threat of cyber attacks. Content moderation and misinformation. Platforms struggle to balance free expression with the need to remove harmful content. These challenges underscore the dynamic and evolving nature of the internet services industry. These usually require continuous adaptation and robust strategies to navigate the complex digital landscape. In this section, we will look at our 4 target companies through the lens of the following financial performance metrics: return on net operating assets, net operating profit margin, net operating asset turnover, and Z-scores. Starting with Shopify, we see strong profitability and solid asset efficiency. A high net operating profit margin of over 21% reflects effective cost control and a scalable revenue model. Shopify's net operating asset turnover of 7.4 shows effective use of assets, and with a Z-score of 36.4, Shopify is financially very stable and shows low risk of bankruptcy. Now let's look at DoorDash. DoorDash boasts an impressive asset turnover with a net operating asset turnover of 10.36, indicating strong sales activity for its assets. However, its net operating profit margin is deeply negative, suggesting high operating expenses. I would likely assume that those come from logistics and marketing. While it's not currently profitable, its relatively high Z-score is still financially stable. What about Uber? Uber operates at a near break-even profitability with a net operating profit margin just above 0. It has a healthy net operating asset turnover of 8.67, showing strong use, and a Z-score of 3.13, indicating a moderate risk of bankruptcy. This suggests financial stability, but there is still room for improvement in profitability. Lastly, let's look at Dropbox. Dropbox stands out for both high profitability and asset efficiency. It has the highest net operating asset turnover of 10.72 and a strong net operating profit margin of 24%. That is supported by a lean subscription-based business model. Even with all that praise, its Z-score was the lowest of all 4 companies, coming in at 1.63, suggesting that Dropbox likely has the highest level of financial risk. Overall, this comparison clearly shows that even within the same industry, business models and risk profiles can vary significantly. And now with that, I'll hand you off to Haley for the growth perspectives segment of our presentation. Thank you.
Thank you, Matthew, for walking us through the profitability ratios and credit risk comparisons across our companies. Now I'll take us into the next part of the analysis, specifically the revenue growth projections and how we derived our forecasts over the horizon and terminal periods. Let's begin with Shopify. Based on historical data from the past 6 years, Shopify has seen consistently high revenue growth, though the annual rate has declined more recently. We modeled this trend using an exponential decay function where the growth rate drops at a diminishing pace over time. For 2025, management forecasts a growth rate of about 21%, and from there we set the rest of the forecast to gradually decay to a 5% terminal growth rate by 2033. While slightly optimistic, this estimate is supported by analyst forecasts and Shopify's expansion into enterprise services. However, headwinds include intensified e-commerce competition and margin pressure. Turning to Dropbox, this is a mature software as a service company with visible decelerating revenue growth since its IPO. Over the past 6 years, revenue has neared stagnation and management has focused on cost containment rather than aggressive innovation. We forecast between 1.4 and 1.1% during the horizon, leveling off at a 1.3% terminal rate, a figure that roughly aligns with long-term inflation expectations. With few tailwinds and strong headwinds like market saturation and limited product differentiation, a conservative terminal rate is appropriate. Next is Uber. Over the last 6 years, Uber has maintained a 16% historical growth, driven by global demand for ride-sharing and logistics. Management has emphasized that logistics and autonomous vehicle expansions are the current tailwinds. We forecast revenue growth starting at 14% in 2025, gradually decaying to 2.5% in 2031. The terminal rate aligns with inflation and reflects Uber's transition towards profitability. For validation, we used Excel's GoalSeek and found a market-implied terminal growth rate of 2.8%, which we view as reasonable given the current growth momentum. Finally, DoorDash is still in a high growth phase, but is constrained by thin margins and increasing competition in the delivery space. Historical revenue growth has exceeded 30%, but is already slowing. Our expectations are moderation in growth going forward. We project revenue to drop from 28% in 2025 to a 3% terminal rate by 2029, capturing a steep fade from hypergrowth. Tailwinds include increasing demand for convenience and logistics tech, while headwinds include market saturation and regulatory scrutiny on gig labor models. Across all 4 firms, our terminal growth rates were selected based on a combination of historical performance, competitive dynamics, and macroeconomic indicators like inflation. Now I'll hand it over to Claire, who will walk you through the value estimates and sensitivity analyses.
Value estimates and sensitivity analyses. The graph above compares each company's equity intrinsic value per share with the stock price as of the fiscal year end. The analysis of intrinsic value estimates for DoorDash, Shopify, Uber, and Dropbox highlight the significant sensitivity of these valuations to changes in terminal growth rate assumptions. At the fiscal year end, a comparison of each company's equity intrinsic value per share against their respective market stock price reveals notable valuation gaps. DoorDash had an estimated intrinsic value of $75.22 per share, yet its market price significantly exceeded this figure. This suggests that the stock price was overvalued, likely driven by market optimism despite ongoing operational losses and margin pressures. Shopify, with an intrinsic value of $20.63 per share, also traded well above its calculated value, indicating overvaluation. The high market price appears disconnected from fundamentals, especially considering increasing competitive pressures in the e-commerce sector. In contrast, Uber's intrinsic value was estimated at $58.89 per share, closely aligning with its actual market price. This suggests the stock was fairly valued, reflecting reasonable market expectations about Uber's long-term growth in mobility and logistics. Dropbox had an intrinsic value range of $60 to $61 per share, yet the stock traded notably below this range. This undervaluation may reflect market skepticism or short-term concerns, although it also underscores Dropbox's sensitivity to modest growth assumptions. Overall, Uber's market price appears most consistent with its intrinsic value, while DoorDash and Shopify show signs of excessive market optimism. Dropbox's undervaluation highlights the impact of market uncertainty on fundamentally stable firms. Sensitivity of intrinsic value estimates. This graph shows the sensitivity of intrinsic value estimates to changes in terminal growth rates for DoorDash, Shopify, Uber, and Dropbox. It clearly illustrates how even modest shifts in terminal growth assumptions can significantly affect valuation outcomes, especially for high growth or highly competitive companies. For DoorDash, the sensitivity analysis demonstrates a strong relationship between terminal growth assumptions and valuation. A higher terminal growth rate of 10% results in a notable increase in equity value, while a lower rate of 2% leads to a significant decline in terminal value. For Shopify, the sensitivity analysis shows that higher growth assumptions, such as 8%, lead to a modest increase in the value per share to $22.42, while lower growth rates, 2%, decrease the value to $19.49. For Uber, the sensitivity analysis shows that a higher terminal growth rate of 4.5% increases the equity value to $73.05, while a lower rate of 1% reduces the value to $51.70. Lastly, for Dropbox, the sensitivity analysis reveals that even small changes in terminal growth rate result in significant fluctuations in valuation, with a 1.75% swing leading to a 15 to 20% impact on the valuation. Market implied growth rate. This graph shows the market implied terminal growth rates that were found using Excel goal seek function. For DoorDash, the market implied terminal growth rate of 9.17% appears overly optimistic, especially considering DoorDash's current negative margins and operational challenges. Given these factors, we recommend not investing due to the risk of overvaluation. For Shopify, the market implied terminal growth rate of 17.6% is highly unrealistic, considering the competitive pressures in the e-commerce space. As a result, we recommend not investing, as intrinsic values remain far below the current market price, even under optimistic growth scenarios. For Uber, the market implied terminal growth rate of 2.8% is reasonable, aligning closely with long-term inflation expectations and conservative growth projections. Uber's strong growth prospects in mobility and logistics support its current valuation. Therefore, we recommend investing, as the market implied growth rate and valuation appear justified under conservative assumptions. For Dropbox, the market implied terminal growth rate for Dropbox is negative 64%, which is highly inconsistent with the 1.25% growth rate derived from our model. This discrepancy indicates potential input or modeling issues. Despite the sensitivity of Dropbox's valuation to growth assumptions, we remain neutral in our recommendation, advising caution due to the model's instability. In conclusion, Uber is the only company with a market-implied terminal growth rate that aligns with its intrinsic value under conservative assumptions, making it a reasonable investment opportunity. In contrast, DoorDash and Shopify appear to be overvalued with overly optimistic market expectations, while Dropbox's valuation remains highly sensitive to growth rate assumptions and is subject to potential modeling issues. Based on these findings, we recommend not investing in DoorDash and Shopify, investing in Uber, and maintaining a neutral position on Dropbox.
Looking at both the qualitative and quantitative aspects of Uber, it is a favorable investment. Qualitatively, the company sector of the global ride-sharing industry is experiencing tremendous growth right now, especially globally. Specifically, according to the Grand Prix research, the global ride-sharing industry is projected to grow at a 13.7% compound annual growth rate from 2022 to 2030. Given Uber's dominant market position and ongoing diversification into sectors like Uber Eats, freight logistics, and autonomous vehicles, a slightly extended forecast horizon beyond the typical 5 years is appropriate to capture its evolving business model in the industry's continued growth phase. This takes me to the quantitative analysis of Uber. When doing the parsimonious forecasting model, we did a 6-year horizon period with sales growth starting at 14%. This was because historical net sales trends showed Uber had a 16.9% growth rate in revenue from 2022 to 2023 and a 17.9% growth rate from 2023 to 2024. We also chose a 2.5% terminal value. All of our estimates leaned heavily towards the conservative side, and when using the goal seek function in Excel and aligning the terminal value to the historical US GDP growth rate, that showed the stock was currently undervalued by about $13 per share. In addition, metrics analyzed in Assignment 1 support the same conclusion. Key financial ratios such as cash from operations to total debt, liabilities to equity, and total debt to equity all indicate that Uber's default risk has declined between 2023 and 2024. Most notably, Uber's Altman Z-score improved to 3.134 in 2024, suggesting strong financial health and a low probability of bankruptcy in near term. While all of these quantitative factors are important, future sales growth and valuation were weighted more heavily in this analysis, as they were the clearest indicators of long-term investor return. These factors, combined with Uber's industry leadership and multi-pronged growth strategy, make it a compelling investment opportunity. Looking at both quantitative and qualitative aspects of Shopify, I would not consider it a favorable investment. Qualitatively, Shopify operates in a highly competitive e-commerce platform space. Additionally, the company's business model relies heavily on small and medium-sized businesses, which are more vulnerable to economic downturns and rising interest rates. While Shopify has strong brand recognition and a large user base, these advantages are offset by increased competition from larger players like Amazon and Wix, limiting its pricing power and long-term scalability. Moving to quantitative analysis, we forecasted an 8-year horizon period for Shopify using the parsimonious method. The growth rate started with 20.7% due to management forecasts. However, even with optimistic assumptions of a terminal growth rate of 5%, we are still seeing highly overvalued stock due to market price. Based on the overvaluation, I would steer investors away from Shopify. Although Shopify's chance of default did decrease from 2023 to 2024, it is notable to point out that their current ratio went down from 7 to 3.7 in 2024. This decline may signal weakening short-term liquidity and a reduced buffer against financial shocks. When making an investment decision, future revenue growth and intrinsic valuation should be considered more heavily, as they directly impact long-term shareholder equity returns and reflect the company's potential to generate cash flows. These factors provide a clear picture of whether a stock is over or undervalued relative to its fundamentals, especially compared with conservative forecasting assumptions. Looking at both the quantitative and qualitative aspects of Dropbox, I would be cautious about recommending Dropbox to investors. Qualitatively, Dropbox is now a mature technology business that has gone past its high growth stage after its IPO in 2018. Its core industry, cloud storage, has a high level of saturation, and Dropbox faces a price war and limitation in expansion as big competitors like Microsoft, Google, and Apple offer bundled services. In the face of such a saturated market, Dropbox eyes its profitability and operational efficiency rather than its aggressive revenue growth. This is clear from the cost-cutting goals and job undercuts taken in 2023 and 2024. Though Dropbox has worked on innovating new business lines like Dropbox Song and DocSend, these innovations have not been able to boost revenues dramatically. Therefore, the growth in the coming years is expected to be minimal and at most marginally above the figure for inflation or GDP growth. This leads me into my quantitative analysis using parsimonious forecasting. We chose a 4-year horizontal period with very slow growth rates to simulate how it's a mature company. Based on the DCF model, Dropbox is highly undervalued compared to market closing price for 2024. However, this could be partially due to the fact that Assignment 2 had a minimum of 4-year horizon period, and Dropbox is already in a state of maturity. In addition, Assignment 1 ratios and metrics also leave us having some hesitations about investing in Dropbox. Although the coverage ratios show a lower chance of risk of default from 2023 to 2024, the significant drop in RNOA is something investors should be aware of because this drop likely shows a decline in Dropbox's ability to efficiently generate profit from its operating assets. Even though Dropbox's Z-score slightly rose in 2024, it is still in the distress zone. Based on all these qualitative and quantitative factors, I would probably not recommend that investors choose Dropbox, even though it is undervalued based on the DCF model. And finally, looking at both the quantitative and qualitative aspects of DoorDash, I would be cautious about recommending DoorDash to investors. Qualitatively, DoorDash benefits from strong brand recognition and a leading position in the US food delivery market, but the industry is highly competitive and characterized by low margins. The company is making efforts to diversify into grocery and convenience delivery, which could support future growth, but it still faces challenges with long-term scalability. Moving into quantitative analysis, we did the parsimonious forecasting method, starting with 27.6% growth to align with the CAGR, which was calculated from 2022 to 2024 growth of sales. Since the market is saturated and will continue to saturate and be hard to differentiate oneself against competitors, growth rate tapers out among a 5-year horizon period. A modest 3% growth rate was given to DoorDash as the terminal growth rate. Although it may be likely that the horizon period for DoorDash is longer or that the growth rates don't decline as quickly, the stock is severely overvalued given our analysis. Despite DoorDash's growth potential, the stock is overpriced given the company's current financial performance and operational challenges, leading to a financial recommendation against investing at the current valuation. In addition, based on metrics in Assignment 1, RNOA for DoorDash has increased substantially, although still negative, and their default risk continues to lower. Their Z-score has also seen improvement, although it is still at a level that investors should be aware of. Based on the improvement in ratios and metrics from Assignment 1 coupled with the concerning overvaluation from Assignment 2 is why I would be cautious when recommending DoorDash to investors. Although DoorDash is making strides on a good trajectory of growth in a market that will continue to experience demand, there is still significant competition from well-established companies and are concerningly overvalued based on our evaluation that we conducted.